Welcome, everyone. My guest today is Seth Appleton, president of U.S. Mortgage Insurers, to talk about the affordability challenges in this market for first-time buyers and the lenders who want to serve them. Seth has deep and broad experience in housing, having served as the president of MISMO, principal executive vice president of Ginnie Mae, and in various policy roles at HUD. He is also the co-chair of the Housing Advisory Council at the Bipartisan Policy Center. I'm excited to dive into today's discussion, but first, here's a word from our sponsor. This is Sarah Wheeler, Editor-in-Chief at HW Media, talking with Melinda Wilner, Chief Operating Officer at UWM, about PA+. Melinda, why should independent mortgage brokers and processors take advantage of this tool?
So it's a great new tool, but we're fans of processing of any way. So whether it's an in-house processor, a contract processor, or using PA+ is a great way to go. We believe that it increases efficiency for loan officers and broker owners to focus on getting new business and working on the business rather than chasing around documents.
Great points, Melinda. And listeners, you can find out more at uwm.com. Seth, welcome to the podcast.
Thanks for having me, Sarah. Great to be here.
Great to have you on. Of course, you are very familiar to many people in our audience. You have been a Vanguard Award winner. You have been, a source that we've used. You've been on various things. And of course, outside of HousingWire, you're very well known. The president of U.S. Mortgage Insurers. And before that, the president of MISMO. I'd love to get a little bit more about your background because you do have a pretty wide range of experience when it comes to the mortgage industry. So tell me a little bit about how you got into the industry.
Well, it's really been a fortunate career journey for me, frankly. I've had the opportunity to focus on housing and mortgage policy from a number of different vantage points, including in the legislative branch as a senior staffer on Capitol Hill, the executive branch as an assistant secretary at HUD and senior official at Ginnie Mae, at MISMO, where we focused on kind of operational and technical standards, and as now the president of a leading trade association advocating for sustainable homeownership backed by private capital. Outside of those things, I'm also currently the co-chair of the Bipartisan Policy Center's Housing Council. And so I've just really been fortunate to be able to work on housing policy from so many different angles because it's something I'm passionate about. And I think it's something that's really important to our country.
Agreed. And this is why I wanted to have you on. I was so excited because, you do come at it with a wealth of perspective. So the first thing I wanted to ask you is, what do you think are the biggest challenges right now to housing?
Sure. Borrowers are facing elevated interest rates right now, high home prices, constrained inventory in many markets. So that makes affordability first and foremost a challenge, particularly for first-time buyers looking to enter the market. And those first-time buyers are the ones who really propel our market forward year over year. Even when rates were lower, supply has been a persistent challenge that really dates back to the financial crisis. In the aftermath of 2008, we underbuilt housing by several million units. Builders have certainly started to meet some of that pent-up demand, but it's going to take more time to address that deficit, particularly for entry-level housing that's affordable for those first-time buyers I just mentioned. And you also have now less of a filtering effect happening where existing borrowers trade up to larger homes, freeing up inventory for those first-time and low and moderate income buyers because of the lock-in effect we're seeing as a result of interest rates gapping up so dramatically from just a couple of years ago as compared to today. The good news is, from my perspective, is that private mortgage insurers are strong, well-capitalized counterparties to the GSEs and stand ready to help those first-time buyers who may not have large down payments to enter the market right now.
I think that's a really interesting observation that, our inventory problems today stem from, the aftermath of the financial crisis when we had the exact opposite problem, right? We had so many vacant houses. We had so many bank-owned properties. And you can understand why that then prompted the home builders to really pull back and really just put a freeze on some parts of the market. But it seems like there could have been a turning point earlier in this cycle to see that, with demographics, that wasn't going to be, workable in the future.
Yeah, there's really strong demand out there, particularly from, younger households who have waited a little bit longer than previous generations to enter home ownership. They're ready to become homeowners now. Certainly the COVID pandemic changed the way that we live and work in many ways. And so as people have moved to new geographic locations or decided they need additional space to work from home. All of those things are continuing to fuel that demand. Um, the good news is that we are starting to see, more supply come online, even with the other challenges I mentioned as far as interest rates and home prices. And the good news is that you don't need 20%, frankly, to become a homeowner in today's market. With private mortgage insurance, you can become a homeowner with as little as 3% down.
Yeah, you mentioned the crisis. I know you've been in the industry for, several cycles now. We'll just say that we're seasoned, right? So, what do you feel like the challenges, how are the challenges today different than the ones that we've had in the past?
I think that's a great question. So I think that the challenges in our housing market are not because there's some fundamental weakness in the housing ecosystem right now. In fact, I think it's really strong. I think today's challenges are a little bit different, and again, they harken back to that lack of supply, putting pressure on affordability issues. That's, as you mentioned earlier, very different than what we saw in the run up to 2008, in which we saw, frankly, um, products that were not good for consumers and not good for taxpayers, that were out there. Look, homeownership is still a cornerstone of the American dream that households are aspiring to achieve. It's still the most widely used mechanism for building generational wealth in our country if done sustainably. I think it's the Federal Reserve's survey of consumer finances that they do periodically, and it typically finds that homeowners have about 40 times the average wealth of renters. And I think that is something we shouldn't overlook. But again, sustainability is really an important aspect of that conversation because we need to simultaneously balance enabling access to mortgage credit with safety and soundness in the system. But again, if we do this right, borrowers can lock in their housing costs at today's rates. They can start to put down roots, and they can begin that journey to building equity. But it's this balance of access to affordable credit with systemic safety and soundness that we always have to keep in mind.
Talking about safety and soundness, so you were the president of MISMO for more than 2 years, and MISMO is a standard-setting organization, right? And it's familiar to people in the industry, but your average consumer's probably never heard of it. But yet, it's really set up, I think, some of the things that we can do going from now into the future, as far as like data collection,
Yep.
standardization. So, when you look back at your time at MISMO, what do you think is some of the most important things that you worked on there?
Look, I think that just the helping accelerate the industry's kind of digital progression was something that I will always look fondly upon. Um, you know, we as a mortgage industry have a lot to learn from other industry sectors that have leveraged data and technology standards to revolutionize the way information is exchanged. Just think about Bluetooth, USB. Those are examples of standards coming from standards organizations that have really facilitated new ways to communicate. The mortgage industry is doing that, and that work was underway at MISMO. And we saw, frankly, during COVID, a continued progression and acceleration of that progression towards digital adoption. I think that the other um, thing that's underpinning that's very important is a move to interoperability, the ability to kind of seamlessly exchange information with all participants in a mortgage transaction. Mortgage insurers, frankly, were at the cutting edge of that within MISMO, developing next generation technologies like application programming interfaces or APIs to be able to exchange information with their customers seamlessly and efficiently.
To me, the APIs really are the game changer, right? Before that, if you're a lender, you have to have all these different things. They don't talk to each other. You have to have someone just to manage all the different things that don't talk to each other. And I think that it really hindered all those things being adopted or being efficient once they were adopted. What do you think when you look at it? You think what is the efficiency that has come into the industry because of APIs?
So I think that it's depends on which portion of the transaction. Again, the mortgage insurers and their customers were really kind of on the cutting edge recognizing that presenting information in a consistent format led to greater efficiency and competition in the market. And so I think that's been a good example. I think in other places, things that consumer facing technologies have really increased their kind of innovation. I think that when we look behind the curtain at some of the processes behind the scenes, there's still probably some work to do. What we did find when I was there is that um, right now you have certain parts of the process that are digitized and certain parts that are still done on an analog or manual basis. And so shifting back and forth between the two um, does not allow market participants to kind of leverage maximum efficiency. And so I think that kind of over the years, this journey um, with organizations like MISMO is going to continue to progress and provide kind of real tangible returns for market participants and for consumers, frankly.
We really see a lot of the standardization happening in the data for valuations, right? Like it's been the push for the last year and a half, and definitely going forward. It's like we have to put some parameters around this so that data can mean something, and be compared and be really make sense as a data set. Whereas like even if we talk about square footage, because there's so much variation in something that seemingly would be very easy to fix, but is not, now easier with some of the technology we have. But what are the other areas that you think are ripe for that kind of like standardization of data?
So look, the appraisals for any participant in the market that is evaluating kind of risk and credit, um, appraisals and valuations are very important, and there's been a lot of work done in that space and that is ongoing, I believe. Um, I think that there's work in the servicing space right now as far as just kind of the ability to transfer data. That has been something that FHFA, the CFPB, and the GSEs have been focused on. I think that there's certainly, been a focus, particularly during the pandemic, around kind of remote online notarization and that type of standardization. So lots of opportunity, frankly, in the mortgage space. Um, in various different parts of the transaction. As you know, mortgage transactions have many different participants for good reason, and so standardization helps kind of align all of them around data and best practices. And again, when I was at MISMO, at least the private mortgage insurers were at the leading edge of embracing that standardization and innovation for the benefit of the industry.
I love that. So AI, which has been incorporated in different tech platforms and solutions for years now, this year has really taken the leap into the mainstream and become available maybe on a more individual basis, right? You think of Chat GPT, but that's just one example. What do you feel like are the good things about that and the bad things about that?
Look, again, these are the mortgages can be highly complex transactions. There's lots of participants, and for good reason. And it's really important that we get these transactions right for the benefit of consumers and for the safety and soundness of the system. And so we need to make sure that we're, again, in everything we do, balancing access with prudent risk management. I think that kind of one bright spot that I've seen, examples of at least, are some basic customer service chat functions on websites and whatnot, for common questions and inquiries. That seems to be an area where there's been some uptick in utilization in order to kind of provide customers information maybe outside of normal hours or whatnot. But I think that we're going to have to carefully evaluate kind of future utilization based again on balancing access with safety and soundness for sure.
That's I think what is always the challenge here, because I've been on several panels about this topic at different industry events. I'm going to be on another one this week, and one of the things that always comes up is like you put more technology in the hands of people. It's the compliance part, it's the fair lending part, it's the that are a little bit more difficult. The more you democratize that ability to use the technology, whether it's AI or something else, right? And I know we use AI at HousingWire in different ways, and it's not to be trusted. And for some things, I mean, there are things it does really well, and there's some things right now, at least, it does not do really well.
Well, and I think you have to approach it from the perspective as even if you know, procure third party technology, right? Like you as a, participant in the mortgage ecosystem are still, um, you know, the one obligated to meet the various regulatory and legal requirements of a transaction. And so, you have to have confidence that you are meeting those obligations and requirements in everything that you do.
It's a great point. So you have been, part of some of the housing policy of the past when you were with HUD, and I would love to ask you right now, what do you think are some of the most important policy issues in housing for this market? In other words, like where should government be helping versus the private sector? Like, what do you think those priorities should be?
Well, I can tell you first and foremost that having a coordinated housing policy from, across the government agencies, the GSEs, and the private sector is really important. The role I'm in today, I can talk about private mortgage insurance because it allows qualified buyers, including again many first-time buyers, to access affordable credit through the conventional market. I think that's really important to underscore that the conventional market isn't and shouldn't be just for buyers with large down payments. Otherwise, it would leave many first-time and low and moderate income borrowers on the sidelines. The insurance and guarantee programs at HUD, USDA, and the VA play an important role in the market, which should be complementary to the role of the conventional market backed by private MI. After all, private MI stands in front of lenders, GSEs, and taxpayers when it comes to credit losses, and taxpayers are exposed to credit risk, on the other hand, through the government programs as a first loss position. So we should be working together so that we can make sure that we are serving as many credit worthy borrowers as possible in a coordinated fashion and not, frankly, incentivizing competition between the government and the private sector because that doesn't expand the pie. So I think that we need to look at coordination when it comes to things like, loan level pricing adjustments versus the Federal Housing Administration's mortgage insurance premium. We've seen FHFA undertake a lengthy, holistic review, which USMI was pleased that they did over the last year or more. And in the midst of kind of taking several actions in that space, we also saw FHA reduce its mortgage insurance premium. And so again, I think it's really important that there is a kind of coordinated housing policy so that each entity can serve borrowers and taxpayers to the best of their ability.
In the wake of the financial crisis, we really saw the banks pull back on all forms of mortgage lending, right? They're going to do a loan for somebody who has, an account, and they also do their car loan and whatever, but they're not going to go out and maybe do some of the hard loans, right? And understandably, they got, we all learned lessons in the great financial crisis, but that has really left the IMBs to do a lot of the heavy lifting for all mortgage, but especially maybe for those who would struggle to get a conventional mortgage, for those who don't have so much for down payment. What do you think if there's anything that could lure the banks back into more mortgage lending, or do you think that should even be a goal?
Look, I think it's always good to have a robust number of participants in any market. But for the IMBs, frankly, the Ginny program would look much different today than it currently does. They've been the ones, to your point, out there serving borrowers, for a long time. There's certainly banks that have continued to do that as well and play an important role in the program. And when we were there, when I was at HUD and at Ginnie Mae, I think that the thought was not that we have, too many IMBs. It was frankly that, how do we attract more participants across the board um, into this program because it's important for the housing market. I think that certainly there are issues in the past around use of the False Claims Act versus administrative enforcement that gave some banks cause for considering their participation in the program. I think that we tried to make progress around some of those issues. We tried to, when I was at Ginny, we certainly tried to make progress around things that make the systems and processes at Ginny Mae different from those in the conventional market, um, for technology and data purposes. But again, there is a we should have coordinated housing policy that allows the conventional market backed by private capital and the government insured and guaranteed market, which flows through the Ginnie Mae program, to play their roles and better serve American consumers and taxpayers.
Do you see that the mix of who's doing those kind of loans changing anytime soon?
I not that I can see. I think it's been pretty consistent for the last several years, but it's something certainly as time progresses that I'm sure policymakers will continue to keep an eye on.
So, why? So we have this affordability problem right now. So it's not just that mortgage rates are higher, which they are, but we had that run up in home prices, and we haven't seen a cool down in home prices that many people expected once rates went up. I mean, they've leveled off in some places. In some places, they're still pretty hot. They might have come down in some places, but overall, nationally, it's not like, oh, we're back to 2019 pricing, right? With these high mortgage levels, or even lower than that, considering the high mortgage. And when I say high mortgage, I know historically maybe not high, but compared to the last 3 years, just that, as you said, that sort of shock that people have about that. Why is mortgage insurance even more important in this environment?
Well, according to the National Association of Realtors, the average down payment of a first-time home buyer is now somewhere between 6 and 7%. So that's well below 20%. Fortunately, private MI does exist to close the gap and, in fact, help more than 1 million households secure mortgage financing in 2022. 97% of which were for purchase transactions, and 62% of those purchases went to first-time buyers, and 35% of which had incomes below $75,000. So definitely an important tool to serve first-time and low and moderate income borrowers who otherwise are qualified to enter the market but do not have large down payments. Private MI cuts down on the average time needed to accumulate funds for a down payment and closing costs by 2/3. And so, in a market where borrowers continue to encounter affordability challenges, the existence of private MI is really a game changer for these borrowers. Just think of all the households that were able to lock in their housing costs at historically low interest rates during 20 and 21 through the use of private MI before rates gapped up. Many would still be on the sidelines today or paying much higher monthly payments, but for the availability of this product.
So much of your career has been spent looking at those first-time home buyers, looking at affordability. If you think about Ginnie Mae, what you did at HUD, what you're doing now. If you could, if Seth Appleton was king for a day, what would you do? What action do you feel like the federal government could do or private industry could do that would really make a difference here?
Well, I think it's a couple of different things. One, um, continue to make progress on the supply front, right? Like that, the demand is there. Let's keep making progress on the supply. Um, the other part of it is let's educate consumers that you don't need 20% down to enter the conventional mortgage market. I think that in past surveys that we've done has come to the forefront as a topic where there's more education needed. We are certainly doing that from our perspective, but it's an important point to drive home if we still want first-time buyers to propel the market forward, because it's clear that at an average down payment of 6 or 7%, we're not going to be approaching 20% kind of on average anytime soon.
Great point. What are some of those educational things that USMI is involved in?
Sure, we're going to soon publish our annual report, which talks about how the MI industry has served the market nationally in 2022, and we'll have a state-by-state breakdown that tells you about number of loans, average loan size, credit scores, and whatnot, and really gives you a sense of how MI has closed the gap and allowed borrowers to sustainably and affordably access the conventional mortgage market.
Do you feel like lenders are taking advantage of some of these resources more than ever right now, or do you feel like there's still a pretty big gap of where they're not helping their borrowers understand the 20% myth?
Look, I think that lenders certainly are a great resource and are educating borrowers. We want to make sure that we're amplifying their efforts, partnering with them to make sure that consumers understand their options, and that just because they don't have large down payments, they still may be, credit worthy and able to access home ownership. Again, it's something that we all have a interest in advancing as far as getting that message out there, because first time buyers do propel our housing market forward, and housing tends to be the largest sector of our economy.
So it's been a pretty brutal year, starting about this time last year for first time home buyers, especially people who don't have maybe family money for like the down payment, or high income earners. What do you see going forward? What gives you hope that lenders can continue to serve this segment that, as you said, this is really important for their future and for our future?
What gives me hope is that there are still substantial benefits to home ownership, and there are tools like private MI that exist to help people become homeowners. Even if rates are higher today, you can still lock in, your housing costs in a way where you can have some consistency and stability. And if rates happen to decrease, then you're able to refinance and get a break in that housing cost. Let's not forget that rents are also subject to upward pressure as well, and that the equity building, um, you know, features of renting are not existent, right? Home ownership is still, again, the number one way to build wealth generation over generation, and I think that there's a lot of attractiveness to that.
Seth, thank you so much for being on today. Really appreciate your insights and sitting down with us.
Thanks so much.